Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, y'all. Ira Epstein of Linn & Associates with your metals market update for this Wednesday, the 3rd of May, 2017, and we're about 2:25 in the afternoon. That's p.m. Central Daylight Time. All right, my friends, I watched as the Fed notes were released, the statement today. Remember, there's no conference from the Fed. Right afterwards, gold rallied. I watched it get up into the 1253.50 level. Wasn't higher on the day at any point, but it had come off the lows, and now, about in times of an hour, whatever it is, the market has given all that gain back and it's approaching the lows of the day. Silver down. You want to see a market that let go? Copper. So much for ideas that a strike can help or strike is going on with the Grosberg situation. More important is that China's still talking this weakness, and I think that's what's weighing on this market a bit right now. In addition, a little stronger dollar. So what the Fed said is nothing, and that's what we all expected. The market's still alluding, and they allude, they don't say, to a June rate hike. The probabilities were about 75% as I looked at them just moments ago for a June hike according to the Fed watch page. Okay, so that's a good number. I saw nothing of importance by the Fed about shrinking the balance sheet. I don't think they'd say anything just yet, nor do I think they're necessarily going to announce it all in June. I think that they want to get further down that road. But any way you go with it, the metals are getting hurt today, and it's a day in the red. So let's take a look and see what's going on. It's becoming more and more evident that if gold wants to fall, one of the support zones might be back to the 18-week moving average of closes. I call it the line in the sand, the red line, and that's about from here $12 lower. It would not destroy the makings of an uptrend that could eventually set up. When we come over to the area chart of closes, you've now dropped back $46 from the high point to today's settlement price. You're not going to close at this price. You're going to settle not at $1245.70. You're going to settle at $1248.50 because I have this ability to tell settlement prices at 2:25 p.m. I know you think I'm nuts, but I can tell you that. In the daily bar chart, by the way, they put up the official settlement 12:30 Chicago time, even though you trade to 4 p.m. Central Daylight Time. As you can see, you're slipping back, and it's been pretty much a straight down road in the market here. The market does not have a pattern of bearishness. It's got no pattern in terms of a trend. It's got higher highs and lower lows. It certainly is in a down thrust, though, and you're well under the 18-day average of closes. Now, the 1262.60 level, which is the 200-day moving average of closes, will become something of a resistance point on rallies back up to it, and in between that and the 18-day average when and if it happens. On the way down, I'm not looking for a lot more. I told you that I think that this market's caught between Bollinger Bands. I am not changing my opinion just because you're getting to the Bollinger Band. The market had a heck of a time up here, couldn't break out. You had a failure day. You want me to pinpoint for you the day the market actually failed and this whole thing set itself up? And this is how important my charting course is when I teach this. This is called an outside day up. What did you do? You took out the previous day's low and high, you closed higher, and certainly the highest high of the move. What the market should not do is take out that day's low within the next two trading sessions. Instead, the very next day, it takes it down through it, closes higher. To most people, that's a sign, it's going to be shook off, it's not going to work. Then the market starts backing off. The first objective would be the 18-day average of closes, right through here. If it continues down, if the 100-day average were higher, I'd say that would be the objective. I have nothing in there except the 200-day, which you know, and it came in around 1263. And if it played there forever, and now it seems to be headed down to that lower Bollinger Band for its final support. Once that's finished, I think the game starts afresh. When we get a trend again. Right now, we're reaching down, and this is what I call the washout. And I think it began on that day. I think that and the day after when you broke through that low was it. When we take a look at slow stochastics, they're oversold as can be. So you're getting down to the lower Bollinger Band, you're oversold. I think that's all the reasons for the bears to do some covering. In the gold silver, look at how it exploded. And I will stick my neck out. If you go on my videos, we did a pretty good job here of pinpointing what was going on in that. It's not over yet. You just need more silver to buy gold. So, get your push cart. You're going to be pushing now about 75¼ ounces of silver to get 1 ounce of gold. It's a lot easier to carry that gold, that's for sure. When we come to the gold ETF, GLD, you've got lower highs, lower lows. I said if you drop down here, wouldn't surprise me if you make that run for the lower Bollinger Band, looking for support there. Now, the 200-day moving average is 119.57, about $1 higher. You're oversold like the futures. I will not be surprised if the market starts looking for traction. In other words, to stop the decline and put the skids on the brake. That doesn't mean it has to go back into an uptrend. It's what I think. One thing that bothers me is I don't want to see the 18-day average of closes get under the 100-day in the gold miners. That would be a real bad sign. When you had a crossover to the upside, you carried the market higher. You start getting one to the downside here, well, what does that spell for all of gold? So there are some things that I am concerned about. In the silver market, you're looking at a combination of an embedded reading with a market riding a lower Bollinger Band. It's the kiss of death for the market. It just keeps feeding on itself into a stronger downtrend until that embedded reading is lost. Now you're getting a join in from SLV doing the same darn thing. Copper market went from a Bollinger Band high 2 days ago. You are down from 269.45 to today's low of 17 cents lower. If you ask me what's going on, I couldn't begin to tell you from a fundamental point of view. I can tell you this is suicide trading. The market's been going like this from upper Bollinger Bands to lower ones, back to a neutral point, back to the upper band and back down, and very difficult to catch a trend in. Very, very difficult. It hasn't given you that sideways action. When you get these broad sweeps and you join in, where would you put a stop? So let's assume you're bearish. You're going to put it over the most recent high, where a lot of people do. That's a 17-cent risk, almost $4,000. I don't think so. In the platinum market, oversold, riding the lower Bollinger Band, and getting excessive now because you're so far under it. So I'd be a bit cautious with that. Doesn't mean it can't get a little more excessive. But I also don't like the fact that the palladium lost its uptrend. That was done today when the market had an outside day down, lost its momentum. It doesn't have to drop as much as the other markets. It's now at the 18-day average, but there's no reason to be bullish this market anymore. If anything, it's trying to act more and more bearish, so I'd be a bit cautious there. And probably the gold, no, I'm sorry, not the gold, the dollar is hurting it. Notice in the dollar, you're losing your embedded reading. Any reading tonight over 20 says that price in the 18-day average, if you get a reading over 20 on a closing basis, you've put into play those two unless, and there's one unless, tomorrow that red line went back under 20. But the higher it gets now away from it, the harder it will be in the math to do that. And the odds favor price and the 18-day average come together, which means other currencies probably falling against the dollar as well. You can read a lot about this in a number of places, but our good friends at Consensus, they do something that's different. I've known Rob Silva, who runs this for decades, literally. And let me tell you what it is. They compile all these newsletters from people all over the country, the different firms especially. And I'm telling you, there's probably 50 to 100 firms that write their newsletters, if not more. Then the newsletters, they take those letters and they make them available to you. They're broken down on their website into sections. One spot you can read all these different letters. In addition, they take those letters from all these contributors, and on Tuesday, they issue what they call their bullish sentiment index. So they take everybody that's writing on the metals, the grains, and so on. Is it bullish or bearish for the market? You get to see what it's doing, and you get an idea. They're offering a 4-week trial. Just give us a call. You can go to our website as well. You'll see our carousel of free offers. Under right here, if you click, you'll see, click here for Ira's free offer. You can do it that way, and the form will appear there, as well as right up here if you're watching me on YouTube. There's an icon that I'm pointing to. Click it, and the form will appear that way. Great idea here. I've been around this for a long time. Good reading. You have a great day. I'm Ira Epstein.